It's showing half,
Yes,
sir.
sir. Yes, sir.
Okay, good, 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 good. All right, good. Um, all right. Like I said, we will not dig too deep today. We're going to start on a note where we're just going to sort of revise a little bit the stuffs that we've already done in financial reporting, where we must have dealt with, um, simple group structure. And I'll come back to what that means. For CR, what we're going to be dealing with will be more of complex group structures. And the fact that I said complex does not mean um, that is going to be the most technical thing that you'll be doing in the paper or even at this level. It's not the most complex thing. It's actually very, very, very simple. But before we do that, I just want to have a run through of the topics that I'm going to be teaching you. I'm going to be handling group structure, the entirety of group structure for this class. That is my main focus. That's going to be my main focus. We should have about maybe an engagement total number of hours of about 30 hours. That may mean about maybe 9 to 10 classes where we're going to deal with the entire spectrum of group structure. And then I still have other standards that I'm also going to deal with. Some of them are very small standards that we can finish under an hour, while some of them, maybe about 2 hours, we can round it up. But it's not about just, having them in class. It's also about practice, 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 practice. If you have studied the past questions for CR, you will notice that, there is um, more focus around standards. So standards are very, very important. As much as we're going to be doing the group structure and everything, I want you to also pay attention to the standards. Very, very important that you understand them. And what is the major difference between standards when you were writing the FR paper and now that you are going to be writing CR paper? Absolutely, if you have been grounded in standards from FR, then you should not have a problem with dealing with CR. The only difference is that there might be one or two things that the scope of your syllabus in FR did not touch when you were dealing with that standard. Or as a matter of fact, the institute will not go to those topics as much in FR, but you cannot expect that to be the case with CR. For instance, a topic like IAS 19, employee benefits may not necessarily be well tested in FR, but it might be something that you would expect to see in your CR paper, you know. So the way the paper is structured for FR is a little bit, the concentration, if you look at it very well, is a little bit different. So I'd like you to pay attention to everything, including statutory and regulatory, requirements for reporting. This is the expectation of the institute is that by the time that you're done with this paper, or you have successfully passed this paper, then, or you're even now qualified, you should have the competency and the professionalism to be able to work with any reporting team of any company, whether it's a single entity or it's a group structure, whatever kind of structure it is, or whatever industry it is. You should now have the competence to be able to deal with the financial reporting or even the audit of financial statements. So that is the expectation, and that is why in dealing with those standards, we will have to go the whole length. Okay. Now, what are some of these standards that I'm going to be teaching apart from what is it called now? Let me just slide through the whole material. Apart from group structure, we're going to be looking at IAS 12 together, income taxes. We're going to be looking at IAS 10. That will be referring to events after the reporting date. We're going to be looking at IAS 33, earnings per share. Earnings per share. We're going to look at IAS 37 together. I'm going to share with you the outline. I'm going to share with you the outline. Let me see. We can see it. Let me share the entirety of my screen so we can see it. A moment, please. Can you see my, sorry, this timetable? What I was saying was this. I was trying to, just speak around some of those standards. So for events after the reporting date, IAS 10, very small, very short standard. What it speaks to, the standard speaks to something very practical, and I want to explain that practical thing. If you work in the finance team of any company, this is what typically happens. Let's say you work with a bank that the financial reporting date, that is the year end, is 31st December of every year. Now, 31st December 2024 has come and it has gone. So you are in the process of preparation of your financial report, right? At the moment, you're preparing your financial statement. I'm very sure auditors are around already, or they will be coming in the coming weeks. And you're already, preparing your book before you will go ahead to publish. Now, in between January 1st, 2025, let's say you are to publish February 28th, 2025. Now, the period in between January to that 28th February, certain events would occur. In fact, some of them may have even occurred in 2024 that your report is not speaking to, meaning that you have not accounted for them. One of those things might be that you might have been served a notice by a customer, say in November, a court notice. The person has a grudge as regards to maybe the way a transaction was treated. And now this person has, through the lawyers or through the company has, through the lawyer, served you a court notice. Now, as at October or November, that came. However, now in January, you are in court. Your lawyers, the lawyers of the bank will look at, of course, the auditor will ask you, do you have any legal issue? You probably would have told your auditor, we have a case, blah, 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 blah. The auditor will ask the lawyer, what is the likelihood that you are going to suffer any liability in this matter? Now, this event has already existed before your financial reporting date. However, the what is it called? The event went on further beyond that date, and now your lawyer is saying, okay, there is a 60% chance. There is a 60% chance that the bank will have to indemnify this customer, meaning that there is a likelihood that the bank will incur a liability. Your auditor will immediately say that since this event had existed, or you could have imagined that you may have incurred a liability, or you may be incurring a liability as a matter of this case, then you should have asked your lawyers and make a provision for such settlement. Now, that would mean that that event will be referred to what we call as an adjusting event, meaning that you will now have to raise an adjustment journal in your books. But there may be such an event that even may have pre-existed before the end of your reporting date, and even with the progress and all of that. But it is not probable that you are going to, or you are likely to be incurring a liability. And in such instance, this is how much we know. And for as much as we know at the moment, it is not probable that you are going to have to incur a liability. In that instance, we refer to that as what? A non-adjusting event. That was a practical example of what we will do when we are going to be dealing with IAS 10. Like I said, it's a very direct, very, very direct standard. It only speaks to what events should we account or adjust for when those events or those things crystallize after the reporting date. That would lead, and maybe some of my explanations have been in that direction because we are going into IAS 37 now. If you have been an accountant for a while, or with the knowledge you have at this point in time, you will understand one thing. One thing an accountant is able to do, one of the gimmicks that an accountant is able to play or able to do, is when they want a particular kind of outcome, they can do what we call, there are various skills and techniques an accountant will go ahead to do. One of which may be to raise a provision. In taxation, for those of us that in taxation in skills, under company income tax, I'm sure you would have heard what the tax law says about when there is a general provision and when there is a specific provision. See, when it comes to provision, IAS 37 prescribes what is the accounting that needs to be done, what criteria meets for you to say you want to raise a provision. There must be an event. There must be an event that you see that it's probable that is going to require you to outflow resources before you can say you want to. You cannot just raise the provision. Oh, we need to reduce the profit for whatever reason. Then we'll now raise the provision, debit expense, credit provisions, or increase in provision. There must be a basis. There must be a basis before we can do that. IAS 37 looks into that. And when there is an uncertainty, we have what is called anything contingency, means that the outcome of that event is dependent on something that, if it happens in the future, then we can say, oh, we have an asset or we have a liability. That's what contingency means. So you may have an instance where that you are liable or you will have an asset is dependent on a future event. So IAS 37 speaks to that. IAS 37 speaks to that. Then we have IAS 33, another very simple and easy, straightforward standard, EPS. EPS will look into, what is the weighted average number of outstanding shareholdings for a company, and what meets up to what we'll call that WANOS, weighted average outstanding number of outstanding shareholdings of the company, so that when company A says their EPS is 10 naira per share and company B says it is 12 naira per share, if they have the same number of outstanding shareholders and they have made the same profit, why should there be any difference? What is causing it? So the essence of standard is so that accountants don't have pockets where they now start to pick up what is, because the information as regards what your EPS is may trigger the decision making of investors to say, oh, if the earning per share is 12 naira in company A, although no experienced investor will make decisions like that. But let's just give a very simple example. And that of company B is 15 naira. Then it may signal that company B is actually performing more than company A. In such instance, it's important that we have standard that, that speaks to how that weighted average number of outstanding shareholding is calculated. In the case of bonus issues, in the case of rights issue, you need that education as an accountant to know what the standard prescribes and how we should go about it. Then there's IAS 7 statement of cash flows. We've done this already at the level of FR. There's nothing more to be taught there, other than I'm going to be linking it with group account. Your group account in FR, you've dealt with balance sheet, statement of financial position, consolidated statement of financial position. You've dealt with consolidated statement of profit or loss. You've dealt with those two. However, you're yet to deal with group cash flow. What is the group cash flow? And there's no big deal to it. It's almost the same thing. We're going to learn that, and then we're going to come to IAS 12 as well, where we'll be dealing with income taxes. Income tax. You probably did not do so much on deferred. I don't know. It depends. I don't know if the syllabus, there is no small gap in between. But I know very well that for CR, we're going to deal much more with regards to deferred tax, liability, deferred tax, assets. When we get there, we're going to deal with that. So my focus for today majorly is group account. Because I want us to, by the time we're done mid-February, I want us to have successfully dealt with group structures to a point where I can confidently say that definitely group question, at least one group question will come out, and you have the capability and competence to deal with it, whether it be a 30 marks question or it be a 20 marks question. You have that capability. That means you've dealt with at least 1/5, or let me say 1/3, about 1/3 of what is needed for you to pass. If you've dealt with that, that gives you a very, very, very good chance of passing CR in one take. And it is very easy, and it is very, very easy and achievable. It is possible to do. Okay. So let's move on to, I'm going to share my screen now back to the material we're going to be using. Do we have any question? Do you have any questions? Or is there any difficulty in terms of, seeing my screen or whatsoever?
So we can only see a picture on the screen, not the display. But I believe this lecture, if it is recorded, maybe Ada you will share it for us.
Okay, I'll share you the allocation between myself and Mr. Wasiu, in as much as he is going to be. But can we see my screen now? Sorry.
Yes, sir. We can see it now.
So you can see that it's the material, right? Is that what is showing on the screen? Okay,
Yes,
good.
yes.
So also apologies that I didn't share this material with you. I was trying to convert to PDF and add some issue. So the plan is this: we're going to have it all together. I think last diet, the materials, the soft copy was shared in piece by piece, and some of the students had difficulty putting them together. So what we have decided to do this time around is to bring the whole pack together, and we're going to share the soft copy with you, so that prior to the class or even while the class is going on, you can always make reference to the notes without necessarily depending on what is on the screen, because you have it on your own as well. Okay. All right. I just want to ask, each and every one of us, I'm going to put up a scale of 10. And I want you to tell me how solid, because I know that FR group accounts is usually one of the most interesting topics that students love so much. I just want you to tell me, on a scale of 1 to 10, how confident and how comfortable are you with group account? Everybody, you can unmute, just tell me, oh, it's 7 for me, or you can use the chat box. It's 10 for me. It's even 10.5 for me, or it's 9, or it's an 8. You can use the chat box, or you can unmute. If you have a challenge, a particular area of challenge that you had when you were doing FR for group accounts, you can also bring that up as well. Mr. Hussein says 50% for me. Okay. Oh, I'm sure the person I said 6/10, just the foreign exchange currency. That means you must have attempted CR before. Abidemi Akonde. Okay. Sonia says it's a 4/10 for me. I want to ask, anybody saying 5, 4, does it mean you've already attempted CR before? Say 5. Or people are being humble. I want to believe. Okay. I believe he says yes. Oh, you have not. You have not. Okay. Interesting one. Zaini, you're going to come to love it, and you're going to come to understand it better. Okay, we're scoring our knowledge, prior knowledge of group accounts, the group structure, our knowledge of it on a spectrum of 1 to 10. How comfortable and knowledgeable are we with it? I know some of us are just being humble with this 4/10 I'm saying. But whichever way, I'm going to take it 5/19 or 5/10. Hey, God. All right. From grassroots to the very end. So let me quickly ask again, is there anybody in this class who did not write FR, or you are coming from the old syllabus. When I say old syllabus, I mean before the introduction of IFRS. I had that during my time when I was writing CR. Okay, to simple group. Yes, it's okay. That's a good foundation for us to start. So when I was going to write CR, I had that issue. We had there were just 2 of us who were coming from FR, and the other 4 or 5 persons that I was in class with were people who were coming from the older syllabus. So it was a lot of work for the lecturer, and it was also affecting me. It was affecting me because we needed to move so that I can progress. It took a bit of time before, or even close to the exam, before we now started moving to complex structures, foreign subsidiaries, group cash flow, and the likes. So we have spent so much time dealing with the simple group structures first. And that took a bit of time. Okay, not to waste too much of time. Let's get to work, a little bit of work here. Okay, now group structure, as we would have known it from FR. Coming. From FR would have been what we call the simple structure. And the simple structure simply means you have a parent owning, maybe if they want to make the question look like it's difficult, maybe a subsidiary, and then it is going to have a sort of associate investment in another company. So it will be an associate in another company. It will be a parent to another company. Most times this is most likely the most, maybe complex, a little bit complex. But when we come to CR, the structure is a little bit more than this. We may have a case whereby a parent owns a subsidiary who is a parent to another subsidiary. Do you understand? And then you will now need to, it definitely means that there is a relationship between this parent and this second subsidiary. However, we're not going to do that today. We're going to come back to this. I just want to lay the foundation, first of all, in terms of who is even a parent, who is a subsidiary, what qualifies as what we will call an associate or investment in an associate. Okay, what qualifies as that? Very simple. What we will call a parent, who we are going to call a parent, is going to be someone who has controlling interest. Any party or any entity that has controlling interest in another company. So if we say this company has controlling interest, what does that really mean? Controlling interest. You see, the key word here is control. Control meaning that this company that we have called parent is able to direct the activities of this other company. Now, there will be one or two things that speak to that will give you the evidence that this company really has that controlling interest. The most basic one is what I'm going to speak of now. What is the most basic one that touchlights that, yes, this company A has controlling interest in company B? And that is what they spoke about here. If you look down here, I'm going to start from ground up. If that company has over 50%, if it owns over 50% of the ordinary shares of another company, then it's as good as saying that let's look at it like this. If we get to the decision making, a company that has over 50% of shareholdings, it is whatever direction they want to go that the company will have to go. That speaks to control. Now, the status that has been achieved is that you have made another company a subsidiary. And now, how do you account for such investment? We account for such investment as an acquisition. An acquisition. And okay, what are the applicable standards in this regard? We have two
Excuse
of
me,
them.
sir. Excuse me, sir.
Hello?
What we are seeing here, are you reading from the material? Because what I'm seeing here is tax base of liability.
Are you serious? Let me
Yes, sir.
see. Oh, sorry. Let me reshare my screen. How about now?
Yes, sir. I'm seeing it now.
Oh, sorry. So sorry. Then let me just close the other one. Sorry. I had opened one initially before the network took us off. I'm really sorry, everybody. So this is what I was speaking about. So let me start all over again. I was saying that the very most simple and most straightforward way to know that company A is a parent to company B is very simple. Company A will own over 50% or more. In fact, sorry, more than 50% of the shareholdings of company B. In that instance, there is no denying it. There is no two ways about it. Company A is 99.9% sure a parent to company B. I said the nature of that investment gives you what they call controlling rights or controlling interest. It makes company B your subsidiary. And when we want to account for it, we're going to account for it as an acquisition. The applicable standard in this regard is going to be IFRS 3 and IFRS 10. Now, IFRS 10 speaks to you have already been exposed to IFRS 10 in FR when you were learning the principles for consolidation. So IFRS 10 speaks to consolidated financial statements. What are the principles that you will adopt in consolidation? And consolidation is very simple. If you have PPE, for instance, I'm sure you must have seen this. A is the parent. It has 50. Let me find another column. Sorry. Let's say A has 50. This is PPE. B has 30. In consolidation, you are simply adding them together. Their consolidated book is the book that brings the assets and liabilities of company A and company B together. Do we always add up like this in every regard? No. But for the most part, we're going to be adding the line by line items that exist in both the book of company A, the parent, and book of company B, the subsidiary. See, it's very straightforward, very simple and direct. So the accounting method is called acquisition. However, the rules that apply to it, or the principle, the standard that guides us, is going to be IFRS 10. And then we are going to have what is also called IFRS 3, which is business combination. Okay. Now, another one, this one we did not do, I'm very sure. I'm very sure we didn't do joint venture. We didn't do joint ventures, or what I would call joint arrangements put together when we were in FR, which is a situation most of the time you have what is called, it could be a 50-50 arrangement, it could be a 33.3, 33.3, 33.3 arrangement, meaning that the right, the controlling right, is split between parties that are acting together equally. So joint arrangements could fall into what you call a joint venture, or what you call a joint operation. Or you could have a case whereby you create what is called an SPE, special purpose entity. And what you're just doing in that regard is you're just doing what we call a joint operation, meaning that there is a particular business activity or line of operation that you want to do together, two different companies. So you now have equal stakes in the operation of that special purpose entity you have created. That will qualify as a joint operation. And you could also have a case whereby two companies come together having 50-50, shareholdings, and they decide to work together, and we'll call it a joint venture. Now, you see, we'll come back to this IFRS 11. We're going to deal with it separately. It's also not a very big standard as much. Another standard under group structure that you must know very well. Okay, now what if my shareholding is between, let's say, is between 20%, but less than 50%? Then what you are going to have is not control. You may not have control, but you have what we will call significant influence. Significant influence. Now, that makes you an associate. Sorry, here the role subsidiary should have been parents. We will correct that before we send you the material. So now, that qualifies as an investment in associate or associate investment. We are going to account for this using what they call the equity method. And the standard guiding that is simply IAS 28, investment in associate. Now, what equity method means is that I will not need to do what I did here, adding 50 and 30 together. No, instead, there's going to be a one line investment in associates under assets in my book. If I have made an investment in an associate, there will be a one line. Now that one line asset will show me the current status of, oh, I invested 50,000 naira, for instance, and now I have gotten a share, a dividend from company B that I invested in, and that makes it to the tune of 52,000. This one line shows that 52,000. I am accounting for it using what is called the equity method. I am not needing to consolidate. That is why there is a separate standard for investment in associate, IAS 28, It is totally different from, when there is an acquisition where we'll be speaking to IFRS 10. Okay. Now, what if my investment accrues to less than 20% of the shareholding? Mr. Wasu is going to deal with this with you in IFRS 9. It is going to be a financial asset, or it could be an equity. All right. So this one you're going to deal with. Some of us would have done IFRS 9 if it's usually tagged as one of the most complex at the level of FR, even at the level of CR to some people. Well, I believe Mr. Wasu is going to do justice to that. He actually lectured me as well when I was writing CR. He's going to do justice to it, where you're going to learn fair value measurements using fair value through POL or through OCI, and then you're going to learn amortized cost. Okay, now when it comes to an overview of interest in other entities, this is everything. Now pay attention to this. How many standards did we mention? We mentioned, from this overview, we have mentioned IFRS 3, IFRS 10, IFRS 11, IAS 28. Okay. There's also IFRS 9 is not part of what we are dealing with, so I won't count it. We've only mentioned 4. I think we've only mentioned 4. But we could also look at IAS 27. IAS 27, if ICANN wants to test you, then we want to go there. Separate financial statements. There could be instances where an entity, maybe by the local regulation, they are allowed to, prepare a separate financial statement, even though they have interest at the level of significant influence, at the level of joint operation, at the level of control in order, they may be allowed to, even if they have acquired another company, there are instances where they can be allowed to prepare a separate financial statement. So that's another thing that was not mentioned here, IAS 27. IAS 27. And then we could also speak to, I think, IFRS 12, which would be a standard that just speaks to disclosure of your interest in other entities. So that standard focuses on disclosure. Now, why am I mentioning this? So that, when we start looking at group in full, attention will most likely be on solving questions, consolidation, complex, what type of complex structure do we have here? How do we deal with foreign subsidiary and all of that? If you're not careful, ICANN may decide not to really go that direction because they know you have gone that direction. And they may decide to just ask some basic question, first of all, with regards to these standards, and give you maybe a small calculation to do. And, what is supposed to be simple will now become a difficult paper. Do you understand? So what we'll do is we'll try as much as we can. We'll try as much as we can to go through, all of that. Even as I move, I'll be reminding you and I'll be telling you to pay attention to certain things, that your examiner may require of you in your exam, that may not necessarily be so much of the calculation that we are going to be dealing with. Okay. So those standards are listed here. Only IAS 27 was not mentioned here. Only IAS 27 was not mentioned. Okay, let's move forward. So we said a parent is, and look at number 4, an entity that controls one or more entities. That definition is coming from IFRS 10. Subsidiary is an entity that is controlled by another entity. As simple as that. So the emphasis is on control. So let's come down to what control really means. It means you have power over the investee. It also could be that there is exposure or rights to variable returns from its involvement with the investee. Now, what I say variable returns, it could go in the direction of the incomes, the profits that is generated by that company. It means that if I am a parent, one of the ways you know that I have control is that I have a right to demand dividends, for instance, from the company, or I am exposed to the losses that that company is making because I've made a controlling investment there and the company is making a loss. It's going to come into my consolidated books. It's going to affect my own profit when we'll be aggregating profits. So also, another way you can also pick control is that there's the ability to use power over the investee to affect the amount of its return. This could have to do with strategy. It could have to be, it could have to do with policy. The parent may give a policy and say, this is the policy you must follow to a subsidiary. Say, this is the policy, or this is going to be, in fact, HR, anything. You have that power to direct the affairs, and in directing the affairs, you could, affect the amount of their returns. Okay. Let me just quickly speak to number 8. We've spoken about consolidation already. Let me just run through what they said. They said these are statements that present the assets, liabilities, equity, income, and expenses and cash flow of the parent and the subsidiary as if they were a single economic entity, as though they were a single economic entity. So, meaning that consolidation is just saying we are going to sum together those assets, those liabilities, those equities, everything. We're going to bring it together, and then we are going to present to you in one financial statement. Now, we can do this during the course of our week. Pick up if you work in a group structure, maybe your company is owned by another company, whether it is a parent or what we normally call, there's a slight difference I want to mention. There's a word I'm missing. Holding, either it's a parent or an holding company. Does anybody have an idea the difference between when it's in your FR, in your CR, the way you're going to work, it does not have any difference per se. In your calculation, there's no difference. But in the real world, there is a difference, a slight difference between what you will call a parent company and an holding company. When most time when they say holdings or holding company, yeah, it's a parent, but there's something they are trying to communicate to you. Anybody has an idea? You can unmute if you know, or you can send it to the chat box. Okay. All right. So what that really speaks to is the fact that whenever they say holding company, most of the time that company is not really, that parent company is not, it's just there for administrative purpose. It's not engaging in everyday operation and business. Do you understand? Meaning that, for instance, you have, and most time what will lead to that could be a regulation. For instance, banking space. At some point in time, the banking business was carrying on too many other businesses. Okay, so if you have a license for banking, do banking alone. Okay, then the banks like First Bank came up with First Bank Holdings, and with First Bank Holdings, you have First Bank, FBN Quest, you have First Bank PLC, you have many of their FBN Merchant Bank. All those banks are under the holding, but at the holding level, it's not like they are doing one. There's no license to do maybe bank. Holdings is just there as the administrative company. It's not engaging in everyday business, as it's the subsidiaries that works for it, and that's what holdings speaks to whenever it is used. Okay, now back to what we were saying. Separate financial statements. It means that an investor could elect to account for its investment in subsidiaries, associate, and joint venture, either at cost or in accordance with IFRS 9, or using equity method in accordance with IAS 28. They could be that election, it could be permitted, and we are going to look at those instances during the course of the class that will permit you to have separate financial statements, even though it is a parent company. You must have also come to understand or to have heard of NCI. Anytime you have a parent and the company is not owned 100%, okay, the other parties will be referred to as NCI. So this is the equity in a subsidiary not attributable directly to a parent. It is also defined as the assets and liabilities controlled by the parent but are owned by other parties. So all other parties, apart from the parent, from the perspective of the parents, when they are consolidating, they will refer to those guys as NCI. Now, does that mean that some of these people don't have significant influence? Yeah, you could have a shareholder that has significant influence. But when the parent is accounting or is reporting, it will refer to them as associates. It will refer to all other shareholders. It will refer to all of them as non-controlling. Their investment will be regarded as non-control, and it will stop you. I believe we all know that already. It will not stop you from consolidating their assets and liabilities in the book of the parent. The only thing is that on a separate line, you will have NCI. That's all. You have NCI to indicate that, okay, this is the value of those investments that is not directly attributable to us as the parents. However, we have consolidated 100% assets, 100% liabilities. Just on the equity, we are now showing you to let you know that this speaks to investments that are not directly owned or attributable to us as the parent, even though we have gone ahead to consolidate 100%. Okay. We're speaking about associates. Let's quickly look at what does significant influence really means. So it is the power to participate in financial and operating policy decisions of the investee, but is not control, neither is it joint control over. You don't have control, but you have the right, you have the power to participate. You can have representation on the board of directors. You will participate in policy making. When there is material transaction, an associate investor should be in the know. And it does not mean they have control. It only means that, like we have said, there's a significant, that's why it stands significant influence. There could be an interchange of management personnel between the two entities. There could be provision of technical information by one entity to the other. But it does not mean that other company has control. Of course, when they are board meetings, they will have representation, they will have directors that are representation of that associate investor, but it does not mean they have as much influence to the level that they control that other entity. Okay, we spoke about IFRS 11 the other time when we mentioned joint arrangement. Joint control is any arrangement in which the parties involved contractually agree to share control of an arrangement. This exists when decisions about the relevant activities require unanimous consent of the parties sharing the control, meaning that it will be impossible for, it's just like joint accounts. It will be impossible for a loan to go ahead without, consulting B. There must be a unanimous agreement before anything is done. I will not spend too much time there. When we get to IFRS 11, we'll deal with what constitutes joint venture and what constitutes joint operation. Okay. Now, what I want to speak on is also a case whereby, we have simplified, and maybe we may have a little bit oversimplified it when we say to be a parent, you one thing that signifies it is that you have over 50% of the shareholdings. You have over 50% of the shareholdings, then that qualifies you as a parent, okay? But there may also be instances where, you have an investor or you have an entity, that entity does not own up to 50%, and yet it has what they call a de facto control, meaning that it will be acting as a parent for that other entity, okay? Now, what is this? They said this is where power is achieved without having majority of the voting rights. What gives you, what we have been referring to all the while is a case where there is, majority voting rights. However, you could also have a case where there is de facto control. In case you are asked, how is this achieved? Okay, now look at the instances. Please pay attention to the instances that we have here. Having less than majority of the voting right, but there is a contractual arrangement between the investor and other vote holders, which eventually gives the investor sufficient voting rights to direct the relevant activities of the investee. Meaning that the shareholders or the people who have voting rights came together and say, okay, we are nominating you, another entity. You are going to, be the one to be in charge of this. Okay, let me give a very simple example. Let's say you have a case whereby maybe, let's even use, for instance, a private company, and you have 20 shareholders. Let's say this is a new company and it is a fintech company. It is a fintech. Okay. Now we have a traditional bank, and these shareholders have elected this bank, this entity, to be the one to supervise and monitor events here. Now, this is all the shareholdings. This bank does not have direct shareholding in this fintech company. However, the shareholders that own this fintech or that are investors in this fintech have nominated this bank to play a monitoring or supervisory role to this fintech company. This gives this bank a de facto control. Don't forget what control is. Control means that you have the power to direct the affairs of the company. You can do it in such a way that it will affect the amount of returns that this company gets. You can do it in such a way that it will affect what is the returns that comes to these shareholders. So if you have such a power to make policy and all of those things, you already have control in this company. In this case, this company does not have greater than 50%, as we have mentioned here. They don't have it. It is only that there is a contractual agreement from the investors of the company or those who have voting rights, and they have nominated an entity to perform a role that gives this other country, this other entity, power and control over this invested invested entity. So we could also have a case where other shares are widely distributed among other investors. I'm coming, give me a minute. You could have a case whereby, and this happens in cases whereby maybe you have only one or two institutional investors. Let's say the shareholdings of a company is, let's say, 1 million shares. 1 million. Now, you have an institutional investor, meaning that, there will be individual shareholders, and you could have companies or what we'll call institutional investors. These are usually corporate bodies. They also buy shares of other companies. Not only individuals buy shares. Now, this institutional investor has, let's say, 250,000. Only that body, only them have 250,000. 250,000 of 1 million should account for 25%. Okay, still not up to 50%, not to talk of even greater than 50%. However, the remaining 750,000 shares are owned by over 100,000, or let's say over 200,000 investors. Meaning that on an average, each person has maybe only 2.5 units of shares. Is it even up to that? Okay, 3.5 units of shares. And there is one investor that has over 250 or 250,000 shares. This already tells you that the vote of this institutional investor is a controlling right in one way or the other. You know why? Because only this one institutional investor, once they make a decision and these other 200,000 shareholders have polarized, when I say polarized, their decisions are not tuning towards the same direction. Meaning that this one chose this, let's say for instance, should we keep KPMG? The KPMG has not been us for the last 3 years. Yeah, we have had some issues. Let's say it's an AGM. Should we keep using KPMG? This corporate body says no. Only them says no. That accounts for 250,000 votes. The remaining 750 was so polarized that at the end of the day, you are likely, let's say we have like 3 options. You are now polarized voting among the remaining 250. It is very much likely that it is whatever this institutional investor has chosen that will likely be the decision that will be taken. So you could have such a situation whereby, I think that was the case with Twitter before it was sold. I'm not sure I'm 100% correct. Twitter had that kind of stuff where you have institutional investors, maybe 2 or 3, owning about maybe 30%. Meanwhile, you have a lot of other people that bought shares. So they're going to have polarized decisions or choices or votes. Meanwhile, one big firm accounts for over 20. Whatever they do, whatever they choose to do or whatever their vote is already accounts for over 25% of the total vote. So that could lead to what we call de facto control. Now, you could also have a case whereby you hold substantive right, an investor will have substantive right arising from acquisition of potential shares in the investee, right to acquire investee potential. Now, what I'm saying, you have a case whereby there is such a let's say for instance, let me still use the instance of this institution. You have about, let's say, coming from this 750, you have about there's a transaction going on where they are going to get additional, let's say, 250,000 shares. Definitely, they are going to come in for sale. The transaction is one. Oh, maybe what is just left is some formality that needs approval from regulator and all of that. That's what is left. It definitely means that to an extent, you already see this one already at 250 and is about to is buying from individuals and it has bought some up to 250,000, additional 250,000. Of course, it's going to come in and control the company. So they don't have it at the moment yet, but there is that potential that, okay, once this goes through, then definitely they are going to have control. So de facto control is the question they can ask you to say, oh, or they can go in that direction and, try and bring something like this and say, if we have a case whereby a company or an investor does not have greater than 50%, is there still a possibility that that company will achieve control over the affairs or activities of another entity? Is it possible? These are the instances where they're going to have that. Okay. 8:30, we round off. Is that okay by us? Hello, my student. Is it okay to round up by 8:30? Are we together?
As today is an introduction part, it's okay.
Okay. Another person, another opinion. Is it okay? Okay. Yes. Okay. Yes. Yes. I've seen a few yes. Okay. I've seen a few yeses. All right. Let's just quickly round up. I'll round up with. I made mention of the fact that it is possible to have what we call separate financial statements. An election to prepare, even though normally you should do consolidation, even though normally you should have what is called equity method in presenting your investment in associates. A company may go ahead to choose to make a financial statement that is distinctly separate. So I can ask you, what are those instances they have asked me for? What are those instances where you could have that? Okay. What are those instances? It says when exemption from the preparation of financial statements is permitted, IS 27 requires that the following disclosures, okay? Sorry. I'm coming, please. One second, please. Okay. Now, what are the reasons why a company may choose or may want to choose not to consolidate? It could be due to poor performance of the subsidiary. Like I made mention of the other time, that the returns, we said that the returns of the subsidiary will affect that of they have a right or an exposure. Yeah, that's the word. Exposure or right to the returns of the investee. Abi? Now, what that means, that exposure is the word for losses, meaning that if they have negative returns, then in their consolidated financial statement, they would have been exposed to that loss to the degree of how much loss the subsidiary has made. So we could have a case whereby there are excess losses to the tune whereby it will deplete the performance of that parent company. It will deplete it so much. So in that regard, they could say, okay, you know what? Let's exercise our rights or our election to not consolidate. You could have a case where you have poor financial position. Maybe it is highly geared. One of the subsidiaries, and 2 or 3 of the subsidiaries are highly geared. So it will now give a picture whereby the parents now look as though they have overborrowed. It could also be due to the nature of the activities, differing activities of the subsidiary from the rest of the group. Imagine a company, the parent is in banking. Meanwhile, the subsidiary is, what do they call hotels? Maybe an hotel, or maybe if the parent is bank and is a banking structure, and then they acquire an investment banking. Yeah, it's okay. If they acquire an asset management firm, okay, it's still in line. If they acquire a pension fund company, it's still in line. But if they acquire a 5-star hotel business and banking business are not really the same. The industry is totally different. The operational scope is totally different. The reach is also different. So they may decide, I know what, we're not going to consolidate the books of XYZ hotels to be part of, because the rest of the group is in banking space. And there's another one, so that could happen. You could also have a case whereby none of these reasons is taken as the only reason for not consolidation. The standard indicates that control must be lost before a subsidiary will be excluded. So now that brings us to regulation. There could be a local regulation or a local law that permits you. So you have instances whereby, and I think I've seen that before, you have a parent that is in Cote d'Ivoire, what is it called, subsidiary is in Nigeria. And don't be surprised that perhaps in Cote d'Ivoire, the companies there are not what is it called? The financial regulation does not speak to IFRS. In such instance, if they now have to consolidate, they will need to prepare and publish IFRS, prepare and publish local GAAP. Do you understand? Now, because of this, they may decide that we are not bounded by, thank God, our FRC, Financial Reporting Council, has not mandated us to prepare our books using IFRS. So they can decide. You could have permissions by your local regulations that allow you not to consolidate if you choose not to. And those are the reasons we have mentioned, the reasons why companies may want to avoid, consolidating. So we're going to start off from here from 4.0 in the next class. We'll look at that and then we'll pick up a question on simple structure. Now, I intentionally did the whole of the theoretical aspects today just to lay a foundation. Because in the spirit of still laying the foundation, we'll pick up a simple, and when I say simple, a very simple group structure question, just to help us remember some of the things we did in FR, and then we'll now gradually step it up in that same class into what we call the complex structure. And then the first complex structure we're going to look at, of course, will not be too difficult. Once you learn how to calculate the holdings of the parents in each of the subsidiaries, then you don't have a problem. All you will need to learn is the same technique you have learned before, but this time around, you pay attention to retained earnings, how you will calculate goodwill, pay attention to the same things that you've learned before as regards, is it pre-acquisition? Is it post-acquisition? Those are the things that, in fact, by the time we're doing the simple structure question, you should start remembering already some of those things that you already learned. So that will be all from me for tonight. If you have any questions or you want to ask questions as regards the direction you're trying to move, what will be our approach? My approach is very simple. I'm going to give you, we'll solve together, then I'm going to require you to solve on your own assignments, because I believe strongly that when you practice and you do it on your own, and you probably, not even probably, you give me feedback. Your feedback helps me to know that, okay, I think when we went this direction, everybody understood, or most of the people in the class understood. When we went this other direction, many people did not. Maybe I need to do a recap of this and solve another question in this under this topic before we move further. It gives me all the feedback that I need for me to move forward. Okay. Any questions? Anything before we end the class? It's 8:31 over here.
Okay, so good evening. So I have a question. This exclusion of subsidiary from consolidation. What if you've already consolidated? I think that's when the consolidation happens. But is that also part of this exclusion where you've consolidated and then that subsidiary now stops doing well? Is this part of the exclusion of subsidiary from consolidation, or this only applies to at the point of consolidation?
Okay, if I get you very well, you mean you have already consolidated. You now see how the performance of that subsidiary affects your reports. Is that what you're saying?
Yes.
So if it's very simple. In no case, if you don't have that permission, if it's not locally permitted, you are not permitted to exercise an election as to consolidation. Whether the performance is terrible or not, you have to consolidate. But if you have an election as to consolidate or not, then in that instance, you can choose, even at the point whereby you have seen that, if you add this, is going, you can always choose not to consolidate.
Okay, so this part, what's it called, deconsolidation? Does it go in? So you're saying it doesn't go in line with this particular exclusion statement from exclusion, just exclusion policy or election from IFRS 10?
I didn't get that.
So I'm saying deconsolidation, right? If the reason of the consolidation, like if let's say I don't know the full details, but like a particular subsidiary was deconsolidated, and from what I learned or the history was that they were not profit making. So, and I think eventually they found a way to make it an associate in investment in associates in their books and no longer a subsidiary. So I don't, yeah. So I'm thinking that the basis is either they is it possible to go from a subsidiary to an associate? What could cause that? And or if it's the fact that they were loss making and then they were excluded from consolidation, and then they just decided to like it says that last line says the standard indicates that the control must be, I think, lost before a subsidiary will be excluded. So I don't know if they lost control. So I'm just giving that
So
case
what
as
that is even, oh sorry. Yeah, what that is speaking to when they say before you will say you are not going to consolidate, you must have lost control. Losing control meaning that there's a very simple way we know you have control, and that was the first thing we made mention of that. If you have over 50%, it's very simple, it's very clear. You have control. If you have not sold, if in that instance, okay, we have sold, let's say for instance, we used to own over 50%, but now we have sold part of that to another entity, which has now reduced our shareholding to be lower than 50%. We may now begin to now say, okay, what are other metrics that we can use that we also mentioned, the factor control, that will tell us that, okay, this company does not have, no longer owns or no longer have control in that industry. In such an instance, it's very simple. You don't even have to. There's no question about it. You are no longer going to consolidate. If it qualifies as an investment in associate, you treat it as an investment in associate. If you have sold to the tune whereby it is now less than 20%, you're just going to take it as IFRS 9, maybe a financial asset or an equity investment. It's just going to be there in your book as an equity investment. However, if it is that you still have over 50, which is the most direct and simple and clear case to know that you have control in the company, you have controlling influence, you will still need to consolidate the subsidiary into your books. You will still need to consolidate into your books. You will still need to consolidate. Is that clear?
hello. Yes, thank you.
Okay, thank you, everyone. All right, we'll meet again next week, Sunday. Before next week, Sunday, we're going to have a class with Mr. Wasiu. I think it's tomorrow. And for my class, we meet next week, Sunday. All right, I think this is where we draw the curtain. See you next week, guys. Somebody said, are you taking the standards on calculation part? Yes, 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 yes. The standards that I'm taking, all calculations around it, we're going to do it together. Just like we'll do group as well. And my standards are just maybe 4 of them, apart from group, IAS 10, IAS 33, IAS 37, and IAS 12 income tax. These are the only 4 standards that I'll be dealing with, apart from anything that has to do with group. All right, thank you guys. See you next.